Ladies and gentlemen, we're going to get started. Thank you for attending the latest installment of the Option Industries Council's webinar series. My name is Nick Ziegler, a staff member here with the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session, how to generate income or buy stock with put options. We'll take a look at put options as vehicles to help you achieve your investment goals. And we'll also take a look at risk-reward scenarios in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of the retail market to the table. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you can submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, how to generate income or buy stock with put options. Joe?
Nick, thanks so much, and thanks to everybody for joining us today. I know we're well into January, but it is our first OIC webinar for 2014, so Happy New Year to everybody, and we hope you'll be joining us as we continue with our webinar program right through 2014. Today's presentation, as Nick pointed out, is all about puts. And I know when I started in the industry way back in the day, puts confused the living heck out of me. I'm happy to say that at this point I think I got it straight, but puts can be very, very confusing. So, we never know the level of education with our many hundreds of listeners who are in on the webinar. But for those of you who are starting out, I urge you, don't be frustrated if you get confused with some of the concepts, because it takes a while, for the whole idea of puts to sink in. At least that was my experience. But we're going to talk about puts in 2 ways today: how to generate income with puts, and also how to buy stock with puts. But of course, before we get started, I think most of you know that the options industry does have the options, the ODD, the options disclaimer document, which talks about characteristics and risks of standardized options. If you haven't already gotten a copy of that, be sure to do so either from the OCC out in Chicago or your broker. There's actually it's a large document that actually is being streamlined by the industry, but believe it or not, there is a heck of a lot of very useful information in that document. That's the ODD, the Options Disclaimer Doc. For those of you who don't know who the OIC is, we are the educational arm of the listed U.S. options industry. We've got 12 different exchanges, that where we are making markets now, and here are those exchanges. A number of them have multiple exchanges, like the NASDAQ, the New York, the CBOE, and the ISE with multiple exchanges. We've then got BATS, BOX, and the Miami Exchange, and of course, the Options Clearing Corporation, the OCC, is also one of the primary funders of the OIC, which is how we are able to bring webinars, appear at live seminars, which we'll be giving across the country. Our spring program will start on February 5th out in Costa Mesa, and I would urge you to check our website for the live seminar presentations that will be starting on the 5th of February. But we've been around for 20 years at the OIC, and it's because of these exchanges and the OIC that we're able to bring all our programs to you free of charge. This is a new slide that we've certainly updated, and this is a history of the industry volume going back to inception in 1973. As you can see, the last 10, 12 years, there's been phenomenal growth in the listed options industry. A lot of different reasons for that, but 2013 was our second best year in history. We averaged between 16 and 17 million contracts traded a day on the various exchanges to get us up once again over that 4 billion contract level. So today's outline, as I mentioned, we're going to be talking about puts, and that is writing puts, selling puts. We'll talk about the basics. We'll look at obviously the risks involved, different motivations for different types of investors. We'll go through return calculations for both cash secured and margin puts, and then we'll get down to the discussion of the importance of planning. And along the way, we're happy to take your questions. So don't hesitate if you've got some questions for Nick to add them into the question box as we go along. So, options, we've got two types of options. We've got calls and we've got puts. Real quickly, calls are the options to buy the underlying, but puts, are the option to sell the underlying. So generally when people think about puts, they're thinking generally about bearish or downward moves in the stock. But that's why we're going to spend time tonight talking about both buying and selling puts, because there are different rights and obligations associated with either side of that equation. So again, put basics. The buyer of the put, also known as the holder, has the right to sell shares of stock. One of those rights is the ability to exercise. And, to get these rights, the buyer or holder pays a premium. And as I mentioned, generally, put buyers are more often than not bearish, although there are positions where you can own puts and own underlyings or different options where it's not necessarily bearish, but, straightforward puts, you're talking about a bearish position. Now, the other side, for every buyer of an option or a put, there's a seller or a writer. And just like the call options, the put sellers have obligations. And their obligations on the sell side of a put is to actually buy the shares of the underlying. And as I mentioned, when I started out, that's where I used to, get confused for a while, actually figuring out that, okay, well, I'm dealing with puts. Puts are bearish. What's this conversation or obligation to buy shares if I'm dealing with puts? Well, that's the obligation that the seller or the writer have. The seller or writer also can be assigned with options, we either exercise or get assigned. Now, to have these obligations and to give up the ability or to actually to potentially be assigned, we collect a premium. So sellers collect premiums, buyers pay premiums, and generally when we're selling puts, we're looking at neutral to bullish positions. So we've got buyers and sellers. That's the case for every option, each one of those 16 million plus contracts that takes place every day. And with, each put buyer, we've got an obligation, a right to sell the shares, and the put sellers have the obligation to buy the shares. one thing that it's important to be straight on is this idea that all of these options that we're talking about, these listed options, are American style. And that's an important distinction, American versus European style. The American style option is an option that can be exercised or assigned at any time from the point you buy it right up until expiration. The other type of option are the European style options, where they can only be exercised or assigned on expiration day itself. So we're talking about American style, where you can exercise or be assigned at any time. So again, just, touching on these important concepts about put basics. Put buyers have the right to sell the underlying share at that all-important strike price. And that's really the next detail we're talking about here. Puts come in all kinds of prices and strikes. They all have rights, but the ability to sell that underlying is right at the strike price. And again, you can do that exercise at any time before the option expires. Put sellers or writers, on the other hand, again, have the obligation to buy the underlying shares, not sell the underlying shares, but buy the underlying shares. So for those of you new to the puts, I hope you'll take away at least this whole idea that put buyers have the right to sell the underlying shares, put sellers have the obligation to buy the underlying shares at the strike price. And we'll go through some examples to clarify this whole idea of strike price, if assigned at any time before the option expires. So in exchange for the put obligations, the seller or writer receives cash. So that's what this is all about, taking on some risk and taking in some cash. And then it gets down to, how much is my risk? How much is my reward? We'll go through some examples. When we receive that premium, we do keep the premium whether we're assigned or not. And again, walking through some examples, whether we actually, if we are assigned, that means we'll actually have to buy the stock. And we'll look at that from either a margin or a cash secured basis. Short put profit potential. Say that quick 3 times. Short put profit potential. The upside profit is limited to the put premium received. It's also the case on the call side. But your short put profit potential is limited to the premium that we take in when we sell that put, less any commissions we pay. The loss potential, the downside risk, is clearly substantial if we understand this concept of selling a strike and getting long the stock below that strike, less the premium we take in. And of course, that's why we're on the call today, to get a clear understanding of the risk versus reward of selling puts. And, we are limited only by the underlying stock declining to zero. So, again, we'll go through a couple examples. Here's a P&L diagram of a short put. You can see that, I'll start first. We've got substantial downside loss potential. Our solid black line goes down dramatically below that break-even point. And as the previous slide said, it's all the way down to the stock getting to zero. So if you got a $10 stock, you sell a put for $1, you've got $9 of downside loss potential and $1 of profit. And you can see that horizontal line. There are 2 horizontal lines. The lower one is the break-even point. The horizontal line above that is the potential profit received, and that is going to be maxing out at whatever price you sell your option, less commissions. So that's a short put. And, there are a couple different motivations for why people do sell puts. So the break-even point, again, a rather simple concept, but one that maybe takes a while to grasp if you're new. First of all, just getting clear what the heck these strike prices are can be confusing. But we've got our strike price minus the premium received is going to be the break-even point, with our put sale. Now, short puts versus the net stock purchase price, upon assignment. And assignment means, we have to fulfill the obligation that a put seller offers, and that is to buy the stock. So upon assignment, the net stock purchase price is that strike price minus the premium received. So let's take a look at a $50 put. We got XYZ, and we sell one $50 put. That means we are taking on an obligation to buy the stock if it's below 50 at expiration. And we're going to sell that put at $2.50. So again, by selling a 50 put, we are taking on the obligation to buy stock anywhere below 50 at expiration. Now, just because you sell that 50 put, and in our example, we're selling it at 250, it doesn't mean, in this case or any, option selling strategy that you need to hold it to expiration. You can get in and out of that at any time. And towards the end of our presentation, we'll talk about planning and how important that is. And it'll speak to, some of the adjustments that you may consider making. So we're selling one XYZ, $50 put at $250. If assigned, we must buy 100 shares of XYZ at the $50 strike price. And, the reason it's 100 shares, most of you may know that each option corresponds to 100 shares of stock. The vast majority of those 16 million contracts in trade are standard options. We do have jumbo options that correspond to 1,000 shares. We have weekly options, not weeklies, but mini options on just a handful that 5 underlines, where are high-priced underlines, where each contract corresponds to just 10 shares of stock, not 100 shares. But the vast majority, each option corresponds to 100 shares of stock. So we sell the 50 put, in our example, $2.50. If assigned, we've got to buy the stock at 50, and we get assigned for two ways. Basically, at expiration, the stock is below 50. That put is in the money, has intrinsic value. So the buyer of that put exercises it and puts the option to you. So they get the short stock, and we have the obligation to buy the long stock. But the next step here in figuring things out is the net purchase price. And this goes to the motivation for an awful lot of put sellers. We have that 50 strike price minus the $250 or $250 that we take in for each put we sold. So it's that strike less the credit taken in gets us our purchase price for the stock. So $47.50. So that in essence would be where we purchase the stock less the commission for selling the put. And clearly, if the stock were higher than $47.50 when we were assigned, we'd have an unrealized profit, and below that level, we'd have a loss, depending on where the stock was when we were assigned. So, some considerations for any put, regardless of the motivation for selling them. Are you as an investor comfortable with owning that stock. That's why we're, selling these puts, potentially to acquire stock or generate income. But, if you're going to get in, even if you're generating, if you're selling puts to generate income, are you comfortable owning the stock if you get assigned? Are you able to buy the stock? Will you pay cash for that stock, or would you be doing something on margin? These are very important questions that, any real serious option trader, especially on the sell side, has to be asking themselves. Net stock purchase price could be less or greater than the current market price, which is what we were just kind of going through, and we will speak to that as we go through the presentation. It's all dependent on the amount of premium we take in. So risk, always critically important with any investment strategy. Our downside risk for the put writer is similar to any shareholder. Well, why is that? Well, we're selling puts, and as we've said, by selling the put, we've taken on an obligation to buy stock. So that's why our downside risk is similar to any stockholder. Net price paid for stock, maybe less than the current market. That just depends on, where we get assigned and where the price is when that happens. Of course, if the net stock price is greater than the current market, we may have an unrealized loss. But that's just a function of the level of the market. Short put, I showed this earlier. There is our P&L graph of the short put. And, does that P&L graph look familiar? Well, how about the covered call? What do you think? Have you thought in terms of a short put being the same thing as a covered call from a risk-reward standpoint? If you haven't, please do. And, with all the presentations we offer, especially, when we're talking to folks who are kind of new to options, many investors are familiar with the whole covered call strategy, but boy, especially many new investors, they don't get a sense because, they haven't really grasped the whole concept. Yeah, they get that, they're selling a call around their long stock and they're generating income. But I think oftentimes that whole break-even point is lost on them, especially early on, and they don't realize some of the risks associated with the covered call strategy. They're exactly the same as the short put.
Joe, I don't want to break in on you right here, but I do want to let you know that we're getting a number of questions on this slide specifically about how the short put and the covered call can basically determine a similar strategy. Could you go into a little bit more detail on that? I think some of our attendees would appreciate that.
Okay, absolutely, Nick. Thanks for breaking in. That's a good thing. And keep the questions coming. The short put, we've gone through. We are selling an obligation, and that obligation is to buy stock at the strike price where you sold it. And then the variable is the price that we take in for the short put. But first and foremost, we sell a put. We're taking on an obligation to potentially have to buy stock if it closes below the strike at expiration or goes down a lot and we get assigned, meaning, we're forced to buy the stock before expiration. That's the obligation of a short put. Downside, significant profit potential. Upside, our premium is maxed out at the level of premium we sold the put for. So that's the short put side. How in goodness name can the covered call be the same thing? Well, it's all about understanding the concepts, the obligations, and the rights. In a covered call, what is a covered call? It is where an investor owns the underlying, and then sells the obligation to sell the stock at the strike. And what do they do, or what does the investor get for selling that obligation? Just like selling a put or selling an obligation. Well, the difference is we already own the underlying with the covered call, and now we've sold the obligation to sell the stock at the defined strike price. So what have we done? We've got, let's go back to our $50 strike. We are long, let's say we're long the stock at 50, that 50 strike, and we've sold the 50 call, the obligation to sell the stock at $2.50. So just like we're on the put side, we sold the put for $2.50. Our maximum profit on the put side would be the $2.50, and our break even would be that strike less the premium taken in, or $47.50. With the covered call, we've got that long stock at 50. We've sold the obligation to sell the stock at 52.5. That's why the line goes horizontal, just like by selling the put. The line goes horizontal at the level of premium that we've taken in. And then what's our downside protection for that long stock? Do we have any in a covered call? Well, the downside protection is the amount of premium we've taken in with the short call. And in the example we're talking about, if we sold the call for $2.50, and we were long the stock at 50, it would be that $50 stock less the $2.50. Our break even would be down to that $47.50 level. But just like the short put, beyond the break even point, what do we have in a covered call? Long stock. And a short call that, as the stock continues to go down, is essentially, it may have some value, but your break even point is $47.50. So the risks and rewards are exactly the same as the graph points out. Significant downside loss potential, because the stock can go from whatever your strike price is, less the premium, to zero. Whatever that difference is the risk on the long side in both these positions. And then to the upside, your profit potential is capped because you can't take in more profit than the put you sold. And on the covered call side, you've delivered or sold the obligation to sell the stock at the strike. So that's something, Nick, that investors, when I do the live presentations, they're all, many shake their head, having a hard time believing that, a short put and a covered call are the same thing, but they are essentially the very same thing from a risk-reward standpoint.
Perfect. I think that should clear it up for some of our guys, and I think we can go ahead and kick it off back on slide 14. Okay,
we'll do. Different investor motivations, where are we trying to buy stock when we sell puts? Is it about generating income, or is it really about acquiring stock? Are we content with assignment and the actual share purchase? If that's the case, are we going to buy the underlying shares? Are we going to do that with margin? These are just all very important questions. Or, is the whole idea about selling puts strictly about generating income, where we really couldn't care less about buying the stock? We want that stock to be above the strike price at expiration or some point before, so we can make a profit, so we can basically buy back our short put, or have it finish out of the money and collect all the premium. So it gets down to, buying the shares. Is that the motivation? Is the motivation for income? So depending on that, I think oftentimes your strike price and the amount of time will vary when you go to actually put on the position. And sometimes, the motivations, tend to overlap. Sometimes the writer is content to receive and just keep the premium. And sometimes, income generators are happy buying the stock. So that's where, having a specific plan and sticking to it, becomes quite important. Let's get to an example. It's March 20th. XYZ, our favorite stock, currently trading at $81.50. Look at that 52-week range. Not too volatile. We've got a low of 78.50 and a high of 76.50. Now, our all-important objective is we'd like to actually buy the stock at 80 or less in about 3 months. And these are various call and put prices in May and June. Remember, we're in March. So maybe we decide to sell the June 80 put. And the June 80 put in our example is priced at $3.90. So again, we're in March. We're looking to acquire stock, below 80 sometime over the next 3 months by selling a put. So what does that mean? Obviously, it means in order to get assigned on this put, that stock is going to have to be below 80 between now and June expiration. Let's look a little bit closer. We've talked about, cash secured versus doing it on margin. If, again, with the goal or the objective of buying stock, the cash secured put means we sell the put, but all important next step is to deposit the cash in full required to buy the stock if assigned, less whatever credit we take in for the sale of the put. So in this case, it's going to be $390 because, again, each option corresponds to 100 shares. So that's the 390 times 100 equals $390 per option. So that's going to give us the $8,000 basically at the strike, less the 390 that we take in. We're going to have to put out $7,610 less the commissions to buy or to put on this cash secured put. If we're assigned, our break-even point is going to be that $7,610, and I hope you get how that works. Strike price minus the premium taken in, 80 minus the 390 gives us that $7,610 break-even less commissions. It really is, if you're new, it's a question of understanding the concepts and then knowing how to connect those dots. And here's the P&L graph, that we looked at without the numbers for both the put sale or the covered call. So again, the break-even point is going to be that $7,610. I hope it makes sense that our maximum profit is $390, to expiration. The maximum profit can't exceed more than the $390 that we took in when we sold the put. There's, one exception. I mean, again, the motivation here is to acquire the stock. If we acquire the stock by putting up the $7,610 and actually take delivery because we're assigned, and then the stock goes up, well, obviously there would be, profit, with the stock going up that we had actually received. So at expiration, we got XYZ at or above 80. If that's the case, the put's worthless, and we collect the $390 as income. That's at expiration. Again, what is the put? The put is the option to sell stock at $80. So if the stock at expiration is above 80, nobody, there's no value to selling the put below $80 if the put's above 80 at expiration. So the way we calculate the return is, you can see the different formula here. I like to go through the numbers themselves. I think it sticks a little more. We've got that put premium, the $390 plus any potential interest over the cash that we had to put up. And again, this is cash secured, so we put up the 7610. And then we've got the time factor. So it's the days of the year divided by our days to expiration, which, we were on March 20th. We were going out 90 days. So divided by 90 days gives us almost a 20% or 21% annualized rate on a cash secured basis, taking in, that 390 over the 7610. If the stock is below 80, again, the primary objective, if that's met and we're assigned, we're going to end up buying stock with a net price of 76.10 because we know that's our break even. So if the stock at expiration is between 80 and 76.10, we'd have an unrealized profit as long as we retain the shares and it remains above that level. If XYZ at expiration, if we get assigned and that stock's below 76.10, we know full well that, we own the stock, but we've got an unrealized loss. Let's flip the coin a little bit and talk about the primary objective being income as opposed to buying stock. Still March 20th, still XYZ, still that same 52-week range, but our forecast is different where we expect XYZ to trade above $80 over the next couple months. And again, we're looking to generate income. So we decide to sell the May 80 put to 310. So a little closer to expiration, a little less premium, and let's take a look to see what happens as we get close to the expiration and how the numbers change when you've got an unsecured put, which means we're doing it on margin. So obviously we sell the put and we collect the cash, the $310, but when we're doing this on margin, we only put up whatever margin amount your broker demands. In our example here, it's an aggressive margin account, that's for sure, where I guess we put up a little bit less than 20% of the original $8,000, and that $8,000 number comes from the strike price because it's the 80 put that we've sold. So in our example, we're putting up just under $1,500, and if assigned, we know that our net purchase price for the stock, which is, a good number to keep track of, because obviously above and below that line, you go from profit to loss. We've got that 80 strike minus the 310, not the 390 as was the case in our earlier example, the 310. And again, it's closer. It's only 60 days, not 90. Our break even here is 76.90 rather than 76.10. So, the break even, very similar chart, whether it's selling a put, whether it's the covered call, just know that downside has significant risk. Your upside profits are capped. But hey, this is a strategy. Only in the last short while has the market started to correct here. Obviously, generally speaking, the market's been going up for darn near 5 years from, the March bottom in 2009. And just very generally speaking, the whole idea of put selling from an income generation stance has worked very, very well for investors for the last few years. Of course, the market's had a couple hiccups, but they have been short-lived and not very, very dramatic. Um, the whole idea of buying stock through put sales maybe hasn't been as effective. Of course, it depends on the stock or the index, but with the market basically rallying hard for the last 5 years, oftentimes those puts have closed out of the money, depending on what put you sold, just because of the upward bias that this at least almost 4 or 5 year bull market has had. But from a unsecured standpoint, where we're talking about generating income, this whole idea of selling puts to generate income has been, pretty profitable for investors. Again, generally speaking, as the market's going up. So at expiration, with an unsecured put, we got the stock above 80, and our primary objective met, meaning the put goes out worthless. We collected $310. From a return standpoint, it gets kind of crazy. Rather than the 76.10 that we had to put up, in this aggressive margin account, it's only $14.80. We've got that $310 cash. We've got the 365 days in the trading year, over 60, not 90 days, for a wildly high annualized return. But that's, most important is not the return itself. It is having a sense for how the return calculation works, both on a cash secured as well as an unsecured basis. So at expiration, if the stock is below 80 and we're assigned, we know full well our break-even point 76.90. So, heck, the stock can be 79.90, and we get assigned that put. Anywhere between 76.90 and 80, we're going to have an unrealized profit. If the stock is below 76.90 at expiration, we get back into that other situation where we now have an obligation to buy the stock, and then it gets back to planning. Are we willing to take delivery of the stock? Are we going to do it on an unsecured or a cash secured basis, and how are we going to manage that long stock position? But that gets into stock planning, and I know we're going to get investment planning, and we'll get into that shortly. So the whole idea of writing puts, I spoke to it very briefly earlier, just the different motivations. The investor is motivated to buy the stock. Maybe, there's a sense that that's a more conservative investor. By depositing the full amount of stock up front, certainly there's less risk. Not less risk, but there is, it is a more conservative approach. Clearly, if we've put up that money, we're willing and ready and able to buy the shares. If, we don't get assigned, if the stock doesn't close below the strike, then we turn into the income collector, and, then we decide what to do next. On the income seeker side, it clearly is more speculative. We're doing these things, on an unsecured basis, less cash up front. The hope and the goal, the objective is for that put to expire worthless. And there, if we get assigned, there's more risk, and, we have to decide, how we're going to handle that. So let's speak to the whole idea of planning. What should an investor do if the stock is above the strike price when expiration is near? When expiration is near. So if the stock's above the strike and expiration is near, of course it depends how high above the strike. If it's not too high above the strike, there's still going to be value to that put. Do we consider just waiting and leaving the put, hoping it will expire worthless? Maybe that's the plan. Do we consider buying back that put? The slide says at 5 cents or at any point. Maybe we have a general rule where a week before expiration or 3 days before expiration, we buy back and get into something else. So, there are lots of different choices out there when it comes to managing your portfolio. And whether that's just a stock portfolio or a stock and options portfolio or just an options portfolio, there are lots of different choices. Have those plans in place. You'd be well served to have certain disciplines, which, you hear the terminology all the time, take the emotion out of investing. I think that that's almost impossible, but defining certain strategies helps you to get to that point. And, a question like this, what do I do if the strike price, if the stock is above the strike, close to expiration? Am I just going to wait? Am I going to close the thing out and roll with something else? Try to have a plan. What should I do if the put expires out of the money and worthless? So we're not before expiration. We're expired. We're worthless. What do we do? Well, it goes back to what type of investor are you? Are you the investor, with an objective to buy the stock who now hasn't bought the stock because the stock did better than expected? Or were we the income put seller, looking for exactly this to happen? Well, what do? Do we write another put on the stock? Maybe that's the choice. Of course, we can't do that blindly. We have to pay close attention to the levels of the underlying, the fundamentals of the underlying, and then I'll throw in there, the market at large as well. I mean, rising tide or a falling tide tend to lift all ships or sink all ships. That's often the case, at least the majority. So, be very, very cognizant of what's happening to that underlying, whether you have the same opinion and maybe the stock's moved up or down. So, do you have the same opinion at a new price level? And if so, have the prices of the puts changed from a volatility standpoint? We're not going to get into vols tonight, but, join us with some of our other webinars or check some of our on-demand webinars because we do talk about volatility an awful lot. It's a critically important aspect to, option usage. But ask these questions and then put strategies in place. Do I write another put on the same stock? Do I write another, do I write a put on some other stock? Is it the same industry? Is it a different industry? Am I, going in a completely different direction? But try to have these different, questions in mind. Really, there is no objective answer to the question. You really have to make your own individual decisions and create your own plans. I hope you do. And I think, maybe the last one to look at is what should you do if the price of the stock begins to decline sharply? And I think really that's why we're going to, kind of wrap up on this third planning stage. Well, with the stock declining sharply, what's happening? Well, chances are we're at a loss. And that's where things, investors sometimes tend to freeze up. Others, if it's part of the plan, like, hey, the strike was 50, I sold the 45 put, my break even's 43, the stock's 25. You're not happy, but hey, I parted at 43, not 50. And that could be fine for some investors. But generally, you really have to have that strong plan in place. And what are your choices? Well, you could roll to another put. And we're not going to go through, the specifics of that here. But if we had sold a 50 put and the stock's tanking, we may want to, because our opinion has changed of the underlying, we haven't, completely thrown in the towel because we still believe in the underlying, but maybe not as much. Maybe you roll that 50 put, take, some semblance of a loss in that, turn around and sell a 45 put. And depending on your numbers, you may lock in a loss to make more money down the road, but rolling your put both down in strike and maybe out in time can be an option. Some investors, as I said, with the 50 strike, we sold the 45 put. Our break-in was 43. They're in at 43. They're holding that short put position, whether the stock goes to 25 or not. That's where they're in. And then there are other investors, who decide, hey, I've reached my threshold. I've got a break-even point. I'm out. Take a loss. Clear the head, and move on to the next, opportunity. So that all-important predetermined plan for some, it's a stop-loss point, is really highly advisable. But really, there is no objective answer. It comes down to each individual investor. So just to wrap it up before we go to questions, Nick, harvesting or collecting premium always involves selling options, okay? If we are collecting premium or selling options, and that could be calls, puts, or both. But critically important is to understand the risk associated with that type of position. Return calculations should not be the deciding factor in any stock or option position. Okay? It's certainly important to know your returns, but you shouldn't, one example, the unsecured put 60 days out gave us 127% return. Don't go shopping option strategies around returns. These are sound strategies. If you believe in the underlying, this is a way to generate income or acquire stock. Follow-up plan, it's not just good in investments, it's good in anything, and it's essential. It will help you make more money and probably more importantly, keep you from losing a lot more money down the road. We really didn't talk too much about early assignment being possible. That is, by early assignment, that means, the obligation that we took on could happen before expiration. When that happens, sometimes that's a taxable event. So, we do at the Options Industry Council have a document on taxes and investing. You can find that online or at the OCC. And we also have the Investor Services Desk where they could, I think, get that to you as well. So I think that's what we wanted to talk about tonight. On the put side, please remember, if you haven't been to our website at optionseducation.org, please do so. And that 888 options number is our Investor Services Desk. We have 6 option professionals there every day before the opening and after the close. After the close on Monday, maybe not because of internal meetings, but they're there almost all the time to take your phone calls or your emails for any options-related questions. So, Nick, speaking of questions, do we have any from the group tonight?
Absolutely, Joe. We actually have quite a few questions. So, ladies and gentlemen, I just want to stay out front reiterating what Joe was saying. Our investor services team is always ready to help you out at 1-888-OPTIONS. They're also available via chat on our optionseducation.org website. If we do not get to your question, then you'd like to do a follow-up. Additionally, this webinar will be archived on On24. You'll receive an email with the link for that, and then you can also look for it on the OIC's YouTube channel within about a week or so. So that being said, as I mentioned, we did get quite a number of questions. And Joe, since this is about earning income, and we're talking about the real nuts and bolts of the investing process here, we got a lot of questions about margin accounts and whether or not those are requirements in order to trade puts for income. Can you talk a little bit about that?
Well, I can, but really at a very surface level, because the margin requirements, it depends on the firm you're working with. So where you're going to get the details, depending on the option strategy that you want to, incorporate, and depending on the risks associated with those strategies, different firms allow different levels of margin. So that really is a firm-to-firm decision. And a couple things. I mean, a lot of investors in this day and age, do the online, investing or trading of options. And oftentimes, they don't know anybody at the firm itself. It is really worthwhile to get to know somebody or a couple people, at your local branch, at their investor services area. It really can be very, very helpful to try to have a direct link to your firm. So when you have a question like, how much margin can I use, you can get a straight answer every time.
Thanks, Joe. And I hope that this question doesn't fall into that same category of it depends, which is sometimes what we have to fall back on. But one of our attendees wanted to know about what's been the most popular option strategy from a historical perspective. Is it just doing simple calls, puts? Is it spreads? Is it more complex strategies? What would you recommend, since we're talking directly today about income-generating strategies?
Well, we touched on a couple things there, Nick. We talked about what was or has been the most popular strategy, and then, maybe what would I recommend? It's hard for me to know exactly, but I believe strongly that, the most popular strategy for investors has really been this income generation idea, the covered call. Well, as we found out tonight, and, I'm not sure how many of our listeners were surprised, but the covered call and selling a put are the very same thing. And so the first part of the question, I think that has been the most popular strategy for retail investors. And then in terms of, what do I think is the best way to, kind of use options? Well, that does fall into the it depends category, Nick, because it depends on I think first of all, everybody wants to make money. We know that. But beyond that, it has to do with your personality as an investor. What is your risk tolerance? And depending on your risk tolerance, and then, also, to a point, it can depend on the amount of capital you are risking. But more importantly, it's, what is your risk tolerance? And depending on that, a couple of my favorite strategies, again, if I really believed in an underlying, I believed the markets were good, selling puts in the covered call, I think, is a good strategy. But I also like the vertical spread strategies an awful lot. But that gets into, a little bit of chart reading. But, for people who have a pretty good feeling about, a handful of charts or stocks and the underlyings, vertical spreads, either on the call side or the put side, can be quite effective because, your potential worst case scenario on the loss side. It's whatever debit you pay, and, you can always get out and maybe, if you were wrong, cut your loss. And, your upside profit potential is capped by the difference between the strike prices and the vertical spread. But, when I'm doing options, I'm not looking to hit home runs. It's great to have a home run, but to me, a home run is more about luck than it is really investing the vast majority of the time. So I'm a big believer in the vertical spread strategies too.
Joe, we got a really good question that popped in. It was about the title of today's webinar, actually, how to generate income or buy stock. And this attendee wanted to know if the selection of a strike price is going to have different criteria if you're looking at income generation versus the acquisition of stock. How should you look at those two?
Well, it's a combination, Nick, and it is a wonderful question. It's that relationship between the strike price and the investor's opinion of the underlying. So, there's that delicate balance between what's the motivation, is it buying stock, is it generating income, and, where's the stock today? How do I think, this stock is going to perform over the next 30, 60, 90 days, and then kind of backing into a strike around that. So that strike price, and, I'm not sure that I even emphasized throughout the presentation how important that strike price is. I mean, that's the point that we have the obligation at that strike. And so it's a combination of the strike plus the current stock of the price and the investor's opinion to how that stock is really going to perform over the period between now and the option expiration. So to me, Nick, it's not one thing. It's really three things: the strike, the current price, and how we think it's going to perform. And then, choosing that strike around, that feeling versus where the stock is currently. So it's a little bit of a mixed bag.
Let's come at it from another angle. I had a couple people write in and talk about stocks they already own. So if they already own that stock and they want to write a put on that, are we looking at the same rules of thumb as you've discussed already?
Well, again, you have to get clearance, from your broker-dealer. But most importantly, okay, what are we doing? If we already own the stock and we sell a put, we're potentially doubling up. The obligation is to buy the stock. Now, granted, we're going to be buying it at a lower price point. It's going to be that strike less the premium we take in. But most importantly, realize full well that, and or the folks asking the question probably do realize, this is essentially doubling up on the position, but it's a way to potentially acquire stock at a lower level. And many of our listeners out there, I'm sure, they've got a handful of stocks that they, feel good about. And, that's where they really can be most effective with option usage, in those stocks where, they have a sense for the fundamentals. They have a sense for, the level of the stock. And then you can pick with some confidence these various strike prices.
Joe, we got time for one last question, and I think this one kind of encompasses a couple different points that I've received throughout this. But people were talking a lot about modeling a specific position, whether that's volatility, whether that's calculating the premium. So why don't you tell people a little bit about the position simulator that we have available at the OIC?
Okay. Will do, Nick. Position simulator, we've got lots of tools on the website, and I think it literally is in the drop-down column under tools. You'll see the position simulator. And I mentioned briefly, but didn't get into it, the whole idea of volatility. For those of you who are a little bit more experienced, or everybody maybe at this point has heard of the VIX. That's also considered the fear level in the market. Well, with the market going down as hard as it has, in the last week or so, the VIX has gone up an awful lot. It's gone from like 12, a low of 12 about a week and a half ago, to a high of 19, I think yesterday, closed just below 16 today. And, by itself, that doesn't necessarily mean anything. And, there probably aren't too many of our listeners who are trading the VIX, and it is a very, very complicated instrument. So don't dive in without spending a lot of time understanding it. But the point of mentioning the levels, Nick, is that as the VIX levels go higher, it typically means that the volatility levels in the market are increasing. And when volatility levels are increasing, there's more movement in the market. When there's more move in the market, there are higher option premiums. Back to this idea of modeling and using the simulator. So you can plug into our simulator, your underlying, the put or puts that you're considering selling. You'll get, one of these P&L graphs that we use throughout the presentation today, and you can change, the price up or down. You can change the implied volatilities up or down. That will change your break-even points. You can change days to expiration. So you can use that tool, costs you nothing but your time, to go in and see how, different strike prices, different volatility levels impact your potential risk and rewards. And I would urge you to do that. So thanks to that listener for the question. That's the OIC position simulator.
Well, Joe, do you have any closing remarks for our listeners today?
Just, Nick, that I'm glad to get our first one for 2014 under our belt. I hope that the listeners will continue to join us. I think we're going to do one of these about once a month going through 2014, and we will, from time to time have some guest presenters as well, where I'll take a back seat and invite some of our colleagues from the industry to offer their expertise on various subjects. And and you'll probably mention that the whole idea of the surveys is important. The two webinars we gave in December, the topics came from our listeners throughout 2013, and we take very seriously your comments. So please do fill out the surveys. So thanks, Nick, and thanks to our listeners.
Ladies and gentlemen, thank you so much for your time today. And for reference, that position simulator for OIC is available under the Tools and Resources dropdown on the optionseducation.org website. Thank you again for your time this afternoon. And as I mentioned, and Joe mentioned as well, if we weren't able to get to your question, feel free to contact our investor services desk at 888-OPTIONS, or their contact information is also available on our website. They're open during business hours, and they're always available to help you with your options questions. Reach out to them at any time, free of charge. Please do fill out those surveys, as Joe mentioned, and please mark on your calendar that we'll be having our next webinar the last week of February. So keep an eye on our website or on your email for the information in the next upcoming weeks. Again, these all are archived on the On24 on-demand platform, and they will also be available on the OIC's YouTube channel. Thank you so much, ladies and gentlemen, for attending our first webinar in 2014, and we hope to see you again in the future.